One of the ways to calculate your returns is by calculating your absolute returns. Let's learn how to calculate this in this video. By definition, absolute return is the difference between your initial investment and the final returns you get from your investment. Suppose you have invested 100 rupees in the year 2018 and that 100 rupees has become 110 rupees in the year 2021, then your absolute returns is 10%. This is mostly used to calculate returns over a short period of time. Here you do not consider time while calculating your returns, and this is one of the drawbacks in this calculation. Here you will be getting positive and negative values considering profit and losses in your investments. Absolute returns is not used to calculate your investment over a longer time frame period. Adding to absolute returns, we have relative returns. But what is relative returns? What does it signify? Let's learn about that in this video. Calculating relative returns is a way to compare your returns or performance to an index or a stock. For example, if your return for a particular year is 10% and Nifty 50 has given a return of 15% for that particular year, then your relative return is negative 5% compared to Nifty 50. Many fund managers measure the performance by relative returns, comparing their performance to an index. They'll perform a global and detailed economic analysis on specific companies to determine the direction of a particular stock or commodity for a timeline. Now you have a good understanding about absolute return and relative return. Let's see how to use this in combination in this video. There should be a scenario in the background for us to compare these two returns in combination. Let's take the scenario of bear market cycle. Here a 2% relative return would be seen as a horrible return, but many investors will be down by an absolute return of 20%. Hence, a 2% relative return is way better than an absolute 20% in this market cycle. A relative 2% return is good in a bear market cycle but is bad in a bull market cycle, especially when there is a bull run happening in the market. As you can see, when we use these two returns in combination, the contest really matters. Mutual fund managers use this combination to compare their fund with a benchmark fund like Nifty 50 or Sensex 30. Mutual fund managers use multiple strategies like short selling or derivatives to gain a positive returns to their fund.